In this video, guys, we're going to look at how we can use indicators more powerfully and how we can avoid the confirmation bias that indicators can give us. Stick around. Hey guys, very warm welcome to you. Thank you for joining me. All right, so in front of you, you've got a FTSE 100 chart. It could be any chart, but we're just using the FTSE 100 for an example. Here, could be gold, could be crude oil, could be cable, could be SPOOs, could be anything. But the point is, guys, is that many of us use indicators to some degree. And I know that sometimes I get a bit of grief because I'm not a huge fan of indicators, but that's not strictly true. Some people think I'm not a fan of indicators. I do use indicators under some conditions. But I do prefer clean charts for making my analysis from. So what I'm going to talk about today, guys, is that this is something, if you feel that you're maybe not as consistent as you like to be, maybe taking substandard trades probably is the cause of that inconsistency, then this might be something to try. It's really easy and really simple, and it might kind of help you think about the way that you look at the markets. So with indicators generally, or with kind of a layout, this is your typical layout for many traders. They've got a couple of moving averages on, they've got a volume on, and they've got something on the bottom. RSI, stochastic, happens to be stochastic here. It doesn't really matter what they are. And you'll come in and you'll look at it and you'll go, right, okay, moving average, we're above the 20 period, we're above the 5, so 5 and a 20 by the way, we're above the 20 period, we're above the 5, stochastic overbought, volume higher, la la la. And immediately your eye is drawn to the indicator value, just because that's just human nature. I feel that we just look at this indicator value, what's happened, and we're looking at the very right hand side of the chart and seeing what's going on. And then we are kind of anchored to that. We're not looking beyond that. Whereas what I'm saying, guys, is that if you start off with nothing on your chart, okay, so you take off absolutely everything. If I can take off the stochastic as well, you take off everything. Suddenly it changes your perspective of what's happened. Now, I'm not saying that your conclusion will be any different, but you tend to then look at the whole chart. You tend to look at the whole chart and see specifically key levels clearly. I mean, it's just, again, personal opinion and viewpoint, but it gives you a little bit more perspective on things and you start to want to dig in a little bit more. Whereas when you're looking at all the indicators, you feel like you've got all the information, like, okay, I've got my RSI overbought, stochastic overbought, moving averages, blah, blah, and you're looking so focused on that hard right. When you've got no indicators, you kind of want to feel and see what's going on. So you start to go, okay, we've been in a multi-year range on this FTSE here. I can do a support level here. There's a support level here. We're broken out of this range. We've had one pullback. We're now in the kind of second deeper pullback. We've just poked above this high. Interestingly, will we hold, will we not? You start to feel a little bit more. And then you can start to bring indicators in. So you start to bring indicators in and go, okay, we've moved down a lot, we've broken out, this is a pullback, how far is it a pullback? I can start to put a fib on if I want, stuff like that. But then bring in stuff in to see and say, right, what was the volume on this drive low? And obviously we know it's heavy, but if you were just analysing a market, you'd want to look at that and go, okay, a lot of volume as we started to sell off, big volume as started to sell off, continued big volume. So this is a significant event. Now this is coronavirus and we know this, so there's no surprise here, but very often if you're analysing a stock or a market or something that you haven't looked at before, you want to know this and you want to see, well, is this something that's important? But the point is, guys, is adding the indicators on as we go, starting off with a clean slate, letting your subconscious, if you like, and your experience just take that and decipher it for what it is, picking out the most important things and then adding on the indicators that you like, the minimum amount that you like. So I'm never a big fan of cluttering up your charts with much stuff, but for indicators are fine when used in moderation. But the process, I think, is very, very key. Now you can start adding stuff on. You can go, okay, well, are we overbought on a stochastic? Because I like to take a first overbought reading after we've had a big significant down move, for example. And you can go, yeah, actually we are on the daily chart now, significant oversold readings. Now we're just creeping to overbought. So if you were considering a short, for example, you start to then go, right, well, okay, the price is telling me maybe there's a short setting up, maybe not yet, maybe it's nearly there because we've poked out of the high. Now the indicator is confirming that I like to look at the overbought stochastic, for example. Let's have a look at some moving averages. 5 is going to be what it is because we've had that persistency of trend and it's probably not going to be so valuable now. Let me flick on my 20. Where are we? Yes, we're above the 20 as expected. Now, does that negate my short thesis? Maybe it does. Maybe I need to look before we get a break at this low. Maybe that's more of a key level. So then you start to bring, you've got the broad analysis, which we did, and we looked at the whole bigger picture, and we had the desire to go back and see the bigger picture so we could frame it in our mind and think about exactly what's happened. Where are we in the bigger picture? Where have we been? Where have we come from? Then we started to add a little bit more data on the volume. The volume said, yes, this is an important move. People are interested in this. There's a lot of excitement around it. Then we started to add on more tools to guide us whether we thought that this short thesis was right. For example, the short thesis. Okay, first overbought, right, great. Then we add on. So you see the point, guys, it's staggering the stuff on, adding it, rather than just literally looking at all the stuff and then deciphering it, because as humans, we automatically make a judgment immediately on it. And that is dangerous sometimes in trading, because you can immediately go, oh, it's the best long ever, it's the best short ever, just because you've looked at one indicator and you've seen this and you've looked at the hard right part of the chart. I think if you take everything off and you take a bigger view, and then you start to add on one by one and see what each individual indicator, if you've got multiple indicators, is telling you. So what's price telling you? What's price position telling you? Now add one indicator. All right, what's the volume in that case telling me? What's the stochastic telling me? What's my moving average? If I'm not using that, what's my Bollinger Band? Or whatever indicator you use, adding it one at a time and deciding whether that information is relevant and what it is trying to tell you. Then you can come up with a far more, in my opinion, a far more objective way of reviewing and looking for a trade. And then you go back through the reverse process. So for example, you say, okay, I'm interested in a short trade. Now you can start to dial these off again and go back to the clean chart. You dial your stuff off, you dial off your moving average, you dial your volume. And if you're using TradingView, very easy to do that with the little hide indicator, and you start to frame your trade and you start to decide, okay, well, if you have got a short thesis, what's the best short thesis here? Do we want to wait for it to come back through this high here? Do we want to wait for it to break? And then you start looking for your actual entry. You say, okay, do I want to look for that to break? Do I want to look for this to break? Or maybe you haven't got a short thesis, maybe you've got a long thesis, in which case maybe you say, I want to wait for it to pull back to here, I want to wait for it to be, you get the idea. You start to then think through what you'd like to look for, and then you go through a cycle yet again and you go, right, what would I want to see, or what would I not want to see on my indicators? So put my volume back on, okay, I'd like to see the stochastic rolling back over, for example, or I'd like to see it rolling back over and finding support if we were long. So you're again framing things from a price perspective and adding on indicators to assist you with the entry. So you're starting off with the review, then you're going to the entry, because again, we get caught in the trap, guys, of just, oh, it's a great short, I'm going to hit it now, I'm going to hit it now. And that's often not the right thing to do. You've got to wait for the price to either confirm if we want to hit it, maybe want a worse price but a little bit more confirmation, or you want to wait for it to go a little bit further and get a better price. Very, very rarely do we want to be just hitting it as soon as we see it. So anyway, guys, that's my thoughts on the process of using indicators. And I think if you are over trading potentially, or if you're taking substandard trades, it might be worth a shot. It might be worth just cleaning the chart off and then adding them on as you see fit, or as you're going through the process, rather than having them all on immediately and being kind of immediately blinded and drawn to what the indicator is telling you. Whatever you're doing there, guys, take care, keep your risk managed, and I'll see you in the next one. Bye bye.